Hey guys, thanks for sharing some time with me today. It was funny as we were waiting for this session. One of the songs that was playing was Journey, "Don't Stop Believing," and I was just thinking, we've been on a shared journey in the last few years. Nazar and I met a couple of years ago at the BAI event in New York, and I think all of us in the community are in a bit of a shared journey as we explore what's next. How do we move faster? How do we enable strategic agility in our organizations and those organizations of our clients? So I wanted to start by just thanking Evan, the BAI team, and all of the volunteers that are just put in a ton of work to make this happen for all of us. So really appreciate it. We're going to jump in. I want to make this a little interactive on the front end, and hopefully we can have some really interesting discussions about the role that finance and funding models play in enabling strategic agility in your organization or those organizations that you support. So we'll kind of keep it simple. We're going to talk about a 4-step path to enabling dynamic portfolio outcomes. So a little bit of structure for our 20, 25 minutes together, maybe 40 with Q&A. I want to start with exploring whether funding models in your organizations or those that you support are an enabler or an impediment to strategic agility. Second, we'll jump into the 4 steps to enabling dynamic portfolio outcomes. And third, this doesn't matter much if it doesn't translate into action. So we'll talk about a call to action, how you can kind of accelerate this process in your organization or the organizations that you support. So always love to start out with a little bit of feedback, and hopefully these questions aren't too self-evident. But if everyone could go to pollev.com /thebeach901. I believe that Nazar has sent that to you in the chat. And just let's answer 2 questions. How important is strategic agility today? So the ability to rapidly adapt your strategy in aligned ways to your organization or the organizations that you work with. Is it not all that important? Strategies are they don't change very often. Is it somewhat important? Is it really important? We often need to fine-tune our strategy over time, and it's critical. We're competing in really fast-moving, complex markets that require us to be very agile and responsive to changes all the time. All right, so this is not a surprise. This is very consistent with what we tend to see. And we make sure not to have 5 questions on this one, because every once in a while we'll get a whole bunch of people that choose the middle question, and it starts looking a little funny. So, all right, we'll give folks just a few more seconds to respond. So we're seeing kind of the broad distribution, kind of centering around important to critical in terms of strategic agility and strategic adaptability in your organization. So then let's look at let's see, we still seem to be getting a couple of responses in, so we want to make sure everybody has a chance to reply. All right, so we got 14%, 50, over 80% are falling into that kind of important and critical category. So why don't we take a look at the next question, which really gets to the heart of today's topic. Is your organization's funding model seen as an enabler or an impediment to strategic agility? I'm going to be interested to talk to folks who say that it's an impediment or to an enabler, because I think most of the groups that I work with, I think this distribution is pretty representative, right? For most groups, I'm going to give you guys just another second to get your response in, but at a high level, for most organizations, funding models are seen as generally pretty bureaucratic, often ineffective, and really an impediment to strategic adaptability. For folks who want a little more information about this, take a look at last year's BAI report. Funding models were one of the key predictors of agility and adaptability in organizations, really across industries. When we think about the role that finance and funding models play, though, it's context is really, really important. So let's kind of rewind the clock a little bit, back to the origins of corporate finance. Most of us kind of forget that the corporate finance function didn't exist until early parts of the 20th century as we know it today. And the context or the keys to winning at that time were really about scaling production, building brand awareness in new markets, building widespread distribution, kind of efficient, repeatable processes, competing on function or price. And competition was really local and sometimes regional. And this is what we commonly think of now as kind of industrial era economics. Look, this was a massive wealth creation period. It was a big step forward. And so the processes that were developed at that time were really perfectly suited for what they were working to solve for. From a finance perspective, then, finance was mostly focused on control. It was focused on cash management, making sure you stayed liquid. It was focused on planning and forecasting, investment governance. Are we investing in the right things and are we getting the right results? And really enabling cost efficiency. And it's interesting because if you kind of rewind the clock a little bit, projects were actually the exception, right? In an environment where the average product refresh cycle was 5 to 9 years, projects weren't the predominant kind of focus for most organizations. Now let's fast forward to the 21st century. We just know we're competing in different markets, and the keys to winning are very, very kind of fundamentally different, right? We're moving from mass production to mass customization, personalization, customer centricity is king. Targeted, mostly digitally enabled branding and marketing. Customer experience is really being seen as potentially the key differentiator. Accelerated innovation and time to market. As we look to personalize and micro segment, you've got to be able to move faster. And we all know this. Competition is truly global, and it's not just global; it's also cross-category. We now see really strong organizations being able to move into new industries and make a huge difference in real time. So what we're really talking about is kind of the age of digital era economics. Not a surprise, but it's really important to think about the context of where we came from, what's evolving, and in that context, likely how we need to evolve our finance practices as well. So it's not that those kind of control-focused aspects of finance go away. We still need to stay liquid. We still need to enable cost efficiencies. We still need to be able to plan and forecast. But moving forward, we also need to enable what we typically think of as strategic agility, right? That ability to innovate predictably, invest in discovery, kind of look at portfolio outcomes more holistically than kind of point by point. And that discussion of really how do we enable more adaptive, more flexible strategy. So in this instance, rather than a 5 to 9 year product refresh, what I think of as big I innovation, continuous innovation, new business models, new products, new markets, is really business as usual, right? We're continually testing and evolving our products. And that focus on personalization and customer experience, it's becoming increasingly more important. And in that context, organizations, they simply need to become more dynamic, without a doubt. So let's take a look at enable increased kind of dynamic portfolio outcomes across your organization. So we'll start with kind of some basic agile concepts. None of the first 2 or 3 aren't going to surprise you. Step 1 is just investing in long-lived, stable teams. That old fallacy of multitasking is a virtue. We all kind of know, that's absolutely not the case, right? Multitasking limits effectiveness, drives high context switching, complexity as you scale, and really kind of, I would say, just sucks for everyone. Like nobody wants to live in that world anymore, right? Now, Solution one then is funding long-lived stable teams. It's a well-understood concept in Agile practices. Bringing work to the teams enables teams to kind of norm, trust, and perform, limits context switching. It makes life a lot better for everyone. It'd be interesting to get some feedback from you guys in some breakout rooms, because while we understand this, a lot of organizations are really still struggling to embrace stable teams, particularly as you get bigger. Now, we've started to measure team stability on a quarterly basis with many of our clients, and we're really surprised to see that still 60% or more teams struggle to have 80% stability quarter to quarter. So let's take a look at step two, from projects to product. The second fallacy is, stable teams are the solution, right? And most of us are aware of this, that long-lived stable teams are part of the solution, but look, project-driven stable teams still have tons of context switching, really steep learning curves. Sometimes you feel like you're being dropped in, mission impossible, trying to deliver across multiple products and satisfy multiple stakeholder. And it's particularly problematic with a lot of technical or domain complexity. So most of us are familiar with the project to product concept, right? Aligning teams with specific products and services that just leverages the strengths of stable teams. It enables them to develop deep, kind of context-specific expertise, and it can be a real key, for improved delivery and innovation. But the reality is, many organizations are really still working to make the journey to product alignment. And maybe a little more controversially, project to product may not be as generalizable an approach in business areas as it is in technical areas. This is an area that we're starting to experiment with a number of our really large clients, but this kind of product alignment may not work in all cases across a large complex organization. So we talked about step one, step two, step three, outcomes-based planning. Again, stable, kind of a fallacy that stable product-aligned teams are the solution. In reality, again, they're just part of the solution. They're key enablers, but without a clear focus on strategic outcomes, we've all seen kind of the feature factory kind of anti-pattern that can happen, right? So unchecked, the focus turns into keeping the teams busy, keeping velocity really stable, rather than maximizing our strategic impact. So, step three, moving to more of an outcomes-based and key result focus, leveraging OKRs. Again, this is generally well established in Agile practices. Aligning stable product-aligned teams to outcomes helps align strategy at all levels of the organization and across the organization, improves focus, provides clear quantitative measures of success, and encourages discovery practices. Look, the reality is, even though we all know this, and it's pretty well established, landing OKRs across an entire organization is actually pretty hard work, right? It's pretty difficult to operationalize. So while this is a clear recommendation, there's a lot of opportunity for improvement across most clients. So let's take a look at step four, which is kind of that next level of opportunity. Excuse me. So many organizations and even practitioners kind of stop at that point. Stable product and OKR aligned teams are the solution. And again, they're part of they're kind of key enablers for increased strategic adaptability, but we don't achieve real strategic adaptability until teams can be kind of dynamically reallocated across an organization to focus on its top priorities. Now, there's going to be some specific caveats around this, so let's dig into kind of the key principles here. First part, take a lean approach to your definition of done and ask yourselves, when have we achieved the majority of value in an area of focus? This is particularly important where we're making major investments in new areas or new products. Two, we want to enable strategic adaptability across the organization. and be able to ask and assess, are there better opportunities, not just with, across your product, maybe not even across your division, but across the entire organization? How do we have kind of a big picture view of where the best opportunities lie? Third, want to factor in potential learning curves. This is a real cost of reallocating capacity into different domains. So we want to be really clear how steep the learning curve would be for teams. This is really important, and I don't want to lose sight of the kind of team and individual and human side of this. I want to proactively address potential impacts to the teams, and ask that, how do we maintain high levels of empowerment and engagement throughout this process? And finally, we want to be really deliberate about the frequency of how often we take this on. And here's some recommendations for each. So as we're creating our OKRs, particularly for multi-year OKRs, we want to pay specific attention to the marginal benefits when crafting your OKRs. So if you're in that second year, maybe even third year of a strategic intent, let's be clear how much upside exists as we think about this opportunity versus others. Second, we want to enable a strong lean portfolio management team at the enterprise level. This is a big gap in virtually every client that I engage with, and at BACG that we engage with. It's something that gets a lot of talk in the community, but we're not seeing a lot of them in practice. And without that kind of air traffic control or holistic view of what's happening across the organization, where the real opportunities are, it's very difficult to enable real adaptability. 3, provide access to multimodal learning resources. That's the first part, but more importantly, in my opinion, is allocate the time for your folks to actually invest in that training and education. We often give people access to lots of learning enablement, but we don't carve out capacity as part of our change plan. 4, reinforce kind of reallocation or kind of swarming to the highest priority in the organization as growth opportunities for your teams, right? I think in the Agile community, I think in general, people embrace an opportunity to grow and to learn. And if we can frame this in terms of, we want to make sure people are working on the most important things to the company, and we're giving people exposures to new kind of domains, new challenges on a consistent basis, and then giving them what they need to succeed. I think there's a lot of kind of framing and change management and messaging that needs to be done there to make sure that it's not viewed as a negative experience for your teams. And then last but not least, right? I think you want to fine-tune allocations, maybe at the team-to-team level, quarterly, and typically think about larger scale reallocation on an annual basis. It's not a firm rule. You could do it semi-annually, but as a rule, if you're thinking about reallocating capacity on a monthly basis, it's almost always too frequent, and the switching costs are going to be too high. So this is kind of, look, if there's one slide that I would have folks take away from this presentation, it would be this. As we're thinking about approaching outcomes more dynamically across the organization, we want to be very, very deliberate about what works and how we kind of approach it in a very thoughtful way. So this isn't just theory. Let's talk about how we drive action and results and experimentation in your organization. So first part, this is a little progressive, right? It's almost almost impossible to enable kind of dynamic, stable reallocation before you have a strong foundation of stable, long-lived teams, before you've aligned teams to products and services. I don't know about you guys, but in our practice, we find it very difficult to land OKRs before most teams are product aligned. Right? If not, the OKR structure gets very fragmented, and you're just trying to satisfy lots and lots of different things. So this is a little bit of a progressive process. Strong, stable teams, product aligned, with some OKR cycles under their belt, then we can have that discussion about higher order strategic adaptability. One, make sure you've got a clear view of opportunities across the enterprise. The enterprise LPM team concept. Let's stop talking about it and start doing it more in more organizations. Two, you've got to address empire building across your culture. This will not work if there's a sense in your organization that incentives are focused on how many resources, how many people are managed. Right? We're trying to move away from that kind of mindset in general in agile and agility circles, but it's an absolute killer to dynamic allocation. So you absolutely have to solve for it. Three, be really explicit about what the assessment process is, how often it's going to take place, what are the drivers, what are the triggers, and make sure that that's broadly socialized and clearly aligned across the organization. Four, love it, experiment. Figure out where it works, where it doesn't. There are going to be areas that are just too technical, too domain specific, and it's not just a technology discussion, right? For specialized international accounting, you're probably not going to have a lot of capacity reallocation going on. For other areas, it's just fine, and it can add a lot of value for your organization. And last but not least, measure the impact as you go, right? You want to have a data-driven understanding of where this is adding value, where it's actually causing headwinds and causing noise across your teams, and where it's really a strategic enabler.